Broadcasting from the commodity capital of the world, Zurich, Switzerland, this is Insider's Guide to Energy.
This edition to Insider's Guide to Energy is brought to you by Fidectis. Go to www.fidectis.com for more information.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and with me, as always, is co-host Johan Oberg. Johan, welcome to the program again.
Thanks, Chris, and good to be on another week and far away from each other this time. We usually be in Zurich, both of us, and this week we're not.
Yeah, I was fortunate enough to go to this place called Houston, Texas. For some reason, when you work in the energy business, you go to Houston from time to time. I'm not quite sure why.
Well, there are some hubs, and I'm pretty sure we will have another hub on the show today as well, which is quite famous for energy. Apart from that, it's quite interesting. We catch up a little bit from last week. We discussed about the weather and the energy prices back and forth, and as a letter on the mail, literally, I got my Swedish energy bill for my house in Sweden, and I almost fell backwards. So it's quite interesting to see the discussions now, especially in the Nordic media, which we might hear from today, regarding energy prices and where this is leading us.
Yeah, and I think this winter is going to be interesting. I had a meeting earlier this week with one of the larger energy producers down in Texas as well, and they don't want to have a repeat of what happened in Texas as well, and they're preparing for February, and there's things coming there. And it was a pretty interesting conversation. We spent a good hour going into the details of what they were doing as an organization and how they were looking to not be caught in the same place they were in the past. But I personally look at Europe and look at all the geopolitics going on as well, and kind of wonder with the U.S. and Russia having a little bit of a tiff going on over the Ukraine and things like that, of how that might affect power pricing and going into the winter as well, and gas pricing that we've seen. So it could be a really interesting winter when it comes to power, at least from the cheap seats, I think.
For sure.
But I think what's exciting to me is the show lines up really well. And you talked about your power bill and did it go up or down or whatever as a consumer. And our guest today is going to really take us through kind of the liberalization of power history all the way up to where we are today, and talk about the trends I think that's taking place, right? So if you go all the way back to the late 90s when they opened up the markets and tried to change things, the idea was power prices should come down, right? From consumers, they should be down. And so when you open your power bill, as you just described, you shouldn't have that heart attack and look at the bill. In theory, it would come down. But the foundation needed to change, right? You had all these monopolies, you had all these things that were just the way Europe was, and Europe changed. Things have evolved, and now we're well into this, and it's evolving again. We have renewables coming in and all this stuff, and I think today's show, it would be a great opportunity to talk about, where asset-backed trading goes, what happens, and then what does that mean for the consumer? What does that mean to the large industrial customers? And what does that mean to the individuals? I think that's the kind of stuff we'll cover today. And that's what I'm excited about. I don't know about you, but that's got me pretty interested in today's show.
No, I agree. And I think also when we set out on the show, we start looking at what are kind of the main topics. And it is the change, it is the transition, and it is renewables. It is the trading, of course, which you mentioned, but also the new technologies that comes with this, and the kind of the whole setup for prosumers. So I think this also ties in very well with kind of the purpose of the show. But also really interesting is, I think it's the first time we have a Norwegian guest on, which is quite strange for being such a center of this energy, the energy world, similar to Houston, Texas, and some other places. So that's also quite interesting.
Well, I think what we should do is let's bring our guest on board and go have the conversation and see where we end up today. I'm happy to introduce Ola Lome to the program. Ola, welcome to the program today.
Thank you, Chris.
So I have the advantage of knowing where you're from, but our audience doesn't. So maybe it makes sense for you to introduce, what company you work for and what it is you do.
Yeah, well, thank you. Well, I'm located in Oslo, Norway, and I think for the topic today, I think it's spot on, of course, talking about power plants and talking about power markets, because I think my educational background is within electrical and mechanical engineering, so I've been into the nitty-gritty details of the power plants, of the penstocks, turbines, and the generators. But and I think power plants in themselves, they're interesting, but to me, the cool stuff starts happening when you connect them to markets, and it's really that I've been working on with, I would say, the majority of the large European power producers the last 10 years. Really, how should they connect their assets to the markets? How should they maximize the value from it? And that's also what Volue, the company that I work for, do as well. We connect assets to markets and try to cover the complete process of a power producer, from really forecasting prices and fundamentals through optimization, trading, and dispatch of power, which of course is a lot in the media these days with what's, at least here in Norway, quite crazy power prices and the start of what could be a challenging winter.
And so I guess to me, you say you take assets and kind of lock them to the market and things like that. Maybe let's start kind of at the primer level and get to there, because I think that that's already pretty advanced. So maybe
Sure.
you want to step back and tell us how it works, and let's go from there.
Sure. I think asset-backed trading is the topic of today, and in this context, when we're in the energy industry and the power industry, it's about power markets and the assets themselves. They're power plants, and when you own a power plant, you have really two objectives. You want to maximize the revenue from it, and you want to operate it safely. And that means connecting them to markets. And power trading kind of, it's quite different from other kinds of commodity trading, for because firstly there has to be a balance between supply and demand continuously all the time, and if not, the frequency or the voltage drops for everyone. And secondly, when we, I think, as we'll learn today, when we talk about power markets and power trading, it's not one market. It's multiple markets. It's the day ahead, it's the intraday, it's the reserve markets. There's multiple markets. And lastly, which also separates it from other kinds of commodity trading, is that your decision have physical consequences. You don't sell paper. If you do sell 10 megawatts of power, you need to produce that volume somewhere. And that means that a physical valve has to be opened somewhere to let gas or water flow to the turbine. So it's, yeah, again, it's not only paper being exchanged, it's real physical power. And that's really what makes it interesting. That's also what makes it really challenging.
And so how is that changing? So you have this physical power plant of some sort, right? And then we spend a lot of time in this program talking about renewables. And so you have virtual power plants, you have solar, you have these smaller distributed power power going into the grid, or in, I think in the example that most people use is kind of into the lake or whatever. You would have all these sources kind of pumping in some sort of energy in, and then you pull it out. So how is that changing, and how's that changing the markets by having that?
Well, I think if we go a bit back and see kind of the investment cycle for traditional power plants, so a large coal-fired power plant, gas, or a hydropower plant, investment horizons are quite long, which means that a lot of the assets that we have in the market today was built a long time ago to a different market structure. And if you go back, kind of the way our power system was kind of organized all around the world, it was around the vertically integrated utility, where kind of the responsibility of generation of delivery to the customer was within one unit. So it was a natural monopoly. But during kind of the 50s and 60s and 70s, we saw that the grids became more integrated, and you saw the emergence of the kind of the first power pools in the US and also in Europe to coordinate generation on a larger scale. And kind of the main objective then became to maximize the social welfare by optimizing these power plants together. That's also when you saw kind of the emergence of the first software companies that also tried to make optimization tools for them. And then, of course, during the 80s, we had new public management and kind of the realization that, which I find really interesting, is that power market is the perfect microeconomic example of how to match supply and demand. Each power plant has a supply curve, and each consumer has a demand curve. And it's in that price cross of the two where the prices match. And kind of microeconomic theory then dictates that, well, social welfare is actually maximized when all players act in a profit maximizing manner. So that works well in the 80s, where we're kind of greed is good, maybe the maybe the term, but kind of what it led to, of course, was the debundling of the former utilities, and we saw in the early 90s the emergence of the first wholesale markets in, I think Chile was first out, followed then by the Nordics, the US in 98, and then also in other parts of the US later.
Which is quite interesting. And if I'm not mistaken, I did some research on Norway. Of course, I always kind of tend to hold a close eye on Norway. And if it was this week or last week, there was a Norwegian politician came out and said this: enough is enough. We should regulate energy prices. So are we seeing them coming back to something, or is this just a one-off political kind of play to get some votes?
Well, I think it is partly a play. I think we're quite locked into the structure that we have today. And I think if you look at it, I think the way it is the rational way to organize the markets as we've done today. But the effect of the green transition, of shutting down a lot of generation capacity and not building it up quickly enough, is really volatile prices. And I think that political part of that is something we haven't really fully taken into account when planning for this. Because no one complained last summer here in Norway when we had zero power prices, and no one remembers that now when they get the high bill. While now you get kind of a political discussion, both on the Norwegian level, but also on European level, if kind of prices should be regulated. Well, I fortunately think we are so far stuck into the current model that it's luckily difficult to get out. But it's kind of, for the industry participant, it kind of questions also their motives in all of this. So it is a discussion that I hope won't get too populistic, at least.
You talked about supply and demand being equal, and we talked about the large assets being tagged to the power plant, or to the trading to the market. And my question is, as we go forward, do we still have that volatility? So Johan said, hey, look, there's some politicians saying we should lock prices because it doesn't look good right now, and we already started the show by saying that we're probably expecting an unusual winter ahead. But if we turn the clock ahead a little further forward, renewables become more predictable coming in, and they're easier to turn on and off. So if you have grid scale storage and your renewables have that, it would seem that things would stabilize over time on the trajectory the market's already on with that. That's my question. Is that accurate?
Yeah, that could be. That depends a bit on the time scale as well. Kind of, if you look at the short term technologically, the options that we have are really gas-fired power plants that's going to provide the flexibility in addition to the hydro reservoirs we have. Longer term, we're of course looking at batteries and hydrogen storage, but it is a big question if and when these become of such a scale that they will influence the market, of course.
So, but with gas, so I was in meetings in Texas this week with some power companies, and a couple of them were European owned, and they basically have gotten mandated away from oil and gas. They're moving away from hydrocarbons as fast as humanly possible, or they're out. And then I met with some North American power companies that said, look, we see gas as the transitional phase until the future, and that it's not going away. We kind of need to have a longer term gas play here, because that is what you just described. So is that a reality? That's why we're seeing the high prices now? Are people, in spite of themselves, driving the market up because of the getting rid of carbon, their carbon footprint and reducing CO2 emissions? Is that part of the problem here?
Well, the gas markets is really what we've seen lately has been something of a perfect storm, I would say. It's a combination of a new gas year, it's high demand for LNG, it's depleted European gas storage, and it's also a high demand for gas to power. I think that has, of course, led to soaring LNG and gas prices, but I think that crunch will be over at some points, and I think the markets are bound to settle, the gas markets. But some of the underlying volatility, they will remain, and that's where we also see we see a growth also in the trading space for short-term gas trading as well.
So if we're going more and more, as I think we all agree onto renewables, maybe even further than we have now, when we have the gas and the hydro as kind of the repository or the battery, so to speak, or the storage. We have the wind and the solar as the big one. We're coming more and more towards the prosumers, which is very small volumes regarding this, which probably means even more volatility. It probably needs some more opportunities for storage, or the need for storage, if that's a gas or if that's something else. But how do you see this? How do you see this transition, and where do you see that from where we were 20 years ago when we had the big power plants? Because it feels like it's an unbalanced asset now.
It is, because I think if we go back to kind of the history talk we had about the standard operation model that grew out of what we had, is that it kind of was, there was two main markets that participants could be active in. And it was the day ahead market, which was a daily two-sided auction. And it was kind of the longer term financial or physical markets for hedging. So the longer term markets. And what we saw that is kind of both the people and the operational mechanism in those two markets were quite different. While the day ahead markets, I think a lot of the people that operated in that grew out really close to the assets. And kind of as the goal is to offer the generation at the right price, and it's a kind of a linear once a day activity. The people involved in that were typically engineers, had grown out of the old regulated world. So not the trading culture at all. While the kind of the longer term, the kind of the hedging activities on the other side was something where people were recruited from commodities trading space. And as the kind of the time horizon was the next month, quarter, or year, the connection to the asset itself was shorter. So kind of the culture was different, and a lot of people made a lot of money, and it was more like a trading culture. And kind of that led within the power producers to two separate groups and cultures. And I think to get back to your question, when it comes to the short-term markets and what's happening now, we need to connect that asset view with kind of the trading forward-leaning view.
And so what tools are there today that are helping facilitate that, right? So I think from what you described, that was a very historic view, right? I think that there's trading is very much alive and well, right? So maybe let's talk about where it is today and where it's going.
Sure. Yeah. I think the development of the kind of these two different groups, they developed different tools. Kind of the day ahead market had the kind of their physical optimization models, and on the other side you had more like those who came from the trading sphere that modeled kind of power plants as options, and from an options theory perspective. And so far these two worlds have been separated, but I think what we see now is a need to kind of connect them much closer. And in today's world, to succeed with asset-backed trading, you need to connect kind of the process of forecasting of prices to optimization, to trading, to dispatch, really the whole chain from power plant to market and back again to power plant much more closely.
I like the one when you have the asset part and you have the trading part. Two kind of different profiles, two personalities, as you said, an engineering and maybe a bit more risk averse financial thing. So that's kind of a journey from one. But you have profile one, you have profile two. What is the third profile? If we're going back to the discussion we had before with this prosumer, a lot of small energy productions, a lot of minimal thing. That means, can a trader do this? Or is the third future option trader free, fully automated? Because how can you make money as a trader on a small battery, or on a small wind farm, or on a small PV on the roof?
Oh, that's a really good question. I think that's something a lot of traders are fearing, of course, because markets will continue to need to evolve towards real time with smaller volumes. And I think we have to remember that equities trading, that was disrupted in less than 10 years. If you look at I don't know if you've seen the photos of the UBS trading floor in kind of from 2005 and 2015. They had like 5,000 traders that were slamming phones and kicking around trash cans. And in what looked like a big stadium, and 10 years later there was nobody left. So kind of in that sphere, kind of automation took the market. Now there is an obvious difference, of course, when it comes to power plants, or local flexibility, because there's a valve that needs to be opened, or something that needs to be regulated. But I think so for the large scale power plants, it could be that the trader is and kind of the production planner is still there doing manual jobs 10 years from now. But if you want to make money on the small distributed assets, it needs to have a completely different scalability, and it needs to be automated kind of for the whole process.
And I assume that is something that you guys are supporting with, and just for our listeners and for my interest as well, how do you kind of bring value to that? What do you actually do?
Well, I think at the bottom of everything, it needs to be kind of a detailed physical description of the real world. Because I think if you overlook a lot of the details, you lose a lot of the added margin. So I think at the bottom of everything, at least we do, is to have fundamental detailed models of the assets, whether they're batteries, gas-fired power plants, or local flexibility. And then you need to have good forecasts coming into them to know what the prices will be, and based on that, create what your kind of your marginal cost curve to be offered towards the market. And then that needs to be connected closely to the trading system and execution, and then back again to really update the power plant schedules.
So what's happening to improve forecasting? What's changing in forecasting? Where your data is coming from, or how often you're getting the data? Are there changes there that are taking place in real time?
I don't know, Chris.
Okay.
But if we go back a little bit to your customers, so you have a little bit of promo on your softwares and the things that you're doing. Who is your customers, and because I can imagine some of the larger companies that are investing a lot in their technology, a lot in their IT infrastructure. So where in this value chain do you sit, and what is the value you bring to some of the ones, the larger energy companies that you mentioned in the beginning?
Well, the majority of our customers are kind of the large and medium-sized power producers in Europe. So it's the Statkraft, the Axpos, the Unipers, and they of course have a mix of the old asset world, but they're also expanding into new renewables. And what we do is try to help them connect these assets to the market in an optimal.
So it sounds like there's a number of changes coming ahead from what we've discussed so far, and it'd be interesting from your perspective is the industry ready for it, and have you got exposure from the customers to where they're at for these changes coming, and maybe that would be worth talking about here.
Sure, I would say kind of the customers that we talk to daily, kind of so the large power producers, I think few have truly understand the implications of the changes that are actually ahead of us. And I think because a lot of these drivers, increased intermittency, shorter gate closures, and so on, have been there for so long without reaching a tipping point, I don't think they've really taken into account what they actually need to do. And I guess that's what we're seeing the result of now in the market, with really much higher short-term volatility. So what I did a few years ago, I did an informal survey among some of the power producers in Europe to see kind of how prepared are you for the upcoming changes. And the question I asked them was really, how long does it take you to do an intraday trade? And I think what I found was quite consistent. And they reported around 10 minutes. And 10 minutes for doing a trade, that sounds, of course, like a lot. But if you look at kind of the discrete steps that are necessary to take that decision, it's understandable. Because firstly, you need to make up your mind of what's the marginal cost you're going to offer your generation to the market. And then secondly, you have to go into your trading system, find an attractive bid, and then execute it. Then kind of goes to the view through kind of capturing the deal, updating the position, changing the schedule, updating the power plant, and updating your reserve market bids. And if you look at all those concrete steps, you see that, yeah, well, it is understandable that it takes a while to do an intraday trade. And
so,
of course, go ahead.
So to optimize that, you still have all the steps. So when you say, are they prepared? If they need those steps, how do they prepare and how do they do it quicker?
Well, I think there's some that's something they have to do, but I think first of all you have to look at each separate step and make sure you do that correctly. Because what I saw is that they didn't always do that. First of all, it's kind of the quality. of the decision itself. Because when a lot of these power producers or traders were going to set their pricing towards the market, they used kind of like strategy values or aggregate values for a longer time of period. And I think talking about back to the connection to the real world, they tend to underestimate the efficiency loss from moving away from the best point. So really, for instance, if you produce 100 megawatts and you want to sell 10 more at the premium, potentially at the lower efficiency, then you have to remember that you don't deteriorate the efficiency of only those additional 10 megawatts. You do it for the whole 100. And that means that you actually need to get paid. If the efficiency loss is 5%, you need to actually get paid double for that additional volume. And what I saw is that a lot of the traders didn't fully take that into account. And I think secondly, also kind of when it comes to the execution of these trades kind of physically, when the open position or load was changed, it often went back to the dispatch center and they could have a completely different view of what unit should be changed than the traders. So even if kind of the trader had done a good job on finding the right deal, it ended up being the wrong unit being run. And then lately, I guess, to your question, scalability. How are you going to manage kind of quality and correct execution and reporting when you don't do one trade, but you do 100 or 1,000 or 10,000 trades per hours? So I would say that it's time now for these kind of large utilities to rethink their whole infrastructure.
So when talking about the infrastructure and change is difficult, and the larger company you are, the more difficult it is with change. You know, I think we've seen that in every industry. But if we look at the quality and the execution of the correct execution, you mentioned the reporting and obviously then scalability, which everything's built on for the future. Is this something that they're lacking in terms of pure knowledge and technology, or is this more of a cultural thing where they're not used to working in this? Where does the problem lie, or is it more kind of does that make sense?
I think the answer is both places.
All right.
I think let's take the cultural part first, maybe, because you have these two worldviews that we talked a bit about in the past with kind of the trading world and the more physical world. And I think what I saw kind of in the same surveys that who were responsible for this trading, that varied a lot between the different companies. So in some companies, the physical world had won, and in general, you saw then kind of a more risk-averse culture, where kind of the most important stuff is balancing our portfolio, and we don't do a lot of prop trading. While on the other side, you saw kind of the trader view that had prevailed, where you saw a lot more risk taking and kind of a lot of attitudes like, I don't give a shit about power plants, I just want to trade. And I think, so part of it is that culture, bridging those two cultures as well. But then when it comes to the underlying infrastructure, this is not that difficult, but it takes a lot of time. Kind of, you need to have that stable foundation. You need to have that stable base step in your data management. You need to have a good framework for automating all of this that robustly. You need to have the right interfaces to do it. And I think a lot of the systems that we see, they've grown out over the last 20 years. But I think now it's really time to rethink a lot of them, start from scratch again by building things bottom up that really connects kind of that physical world also with the trading world.
And so you've been working on this for a while. What is the large energy traders thinking? Are they bought into this? Are they working this in, or are they just trying to survive in today's market?
Well, I think some have taken big steps, and I shouldn't say that everyone does the same, but I think very few have understood kind of the need to do this and also the money that's into actually doing this correctly. Because I would say a lot of them are losing money because they're not doing this job well enough. But there are those who are really good at this, who dedicate a lot of time and resources, and there's those who don't. And I would predict who the winners of the future would be.
So are the newer software architectures or things that are required? So, you know, for me, being in the software industry, I like the modular cloud-based kind of solutions that do these things with APIs. Is the technology lending itself to make that transition perhaps easier because you don't have these big monolithic platforms, or are these large traders so beholden to the monolithic platform that even moving to these newer platforms becomes a challenge for them?
Well, it's both bit of both here as well. I think the future is definitely open, and the future is not the big monolithic systems. But you shouldn't rule out all of them as well, because part of the benefit of a monolithic system is, of course, you have a lot of stuff integrated together. And kind of having an open architecture is great in theory, but there's also then a big coordination work by getting all of these different modules to actually work together and manage all of those interfaces, especially if you choose different vendors for all of them. But definitely the future is open.
And so I think then the value as well isn't necessarily a system, it's the data, right? That you have. And so what I've heard from traders, some of the challenge of moving systems is they have all this historical data in one place, and that's one of the reasons they don't move more quickly as well, just because they have their data siloed in these applications. Is that something you're working with as well, is how to handle the data? Is that part of your, to make these more informed decisions and fix the process? A lot of it is, garbage in, garbage out. So you need the underlying data as well.
You need the underlying data all the way through the value chain from beginning to end. You need good data, and you need a good way of structuring it as well, of course. And I think it will actually be, these things will become even more important because there are some big upcoming changes in the markets that will happen the next 2 or 3 years as well, which will kind of accentuate the need for kind of having your data together.
So what kind of changes would you be referring to?
Well, I think so far we've discussed mainly the day ahead and intraday market, but there's also ancillary service markets. So these ancillary service markets or reserve markets are markets that's operated by the TSO, so the system operator in the different countries, as a way to kind of from second to second balance generation and demand. And these have so far been on a national level, but what we're seeing now is, at least in Europe, a European harmonization of these markets. So it's called the Mari, Picasso, and Terra harmonization projects, which is really about building a common platform for these reserves in Europe, with go lives in 22, 23, and 24. But I think this has an effect also on what we discussed and also the complexity, because take then the new tertiary reserve product, for instance. The requirements there is that it will have to can be activated 7.5 minutes prior to delivery with a 5-minute ramping rate. And for a big power plant, this leaves then really 2.5 minutes to receive the activation, choose what power plant you want to deliver with, and then also send that to the control system. So coordination with that and the intraday market, which is happening at the same time, I think that will be really difficult without automation, of course. So automation is key here.
And so is that automation process being put in place now in preparation for, the year 2, 3 years out? Is that what's being done? Or
again, some people are well prepared for this, while some are not that well prepared for this, at least. And we see a mix of companies that are making their own software for this or acquiring it from a third party, such as ourselves.
makes sense.
So an interesting question. I think both me and Chris has a background in the IT and the software world, where you look at data is king. I'm not sure if that's the right word, or data is the new gold, or whatever we call it. We can always discuss. But is there an opportunity here or a challenge for some of the larger energy companies that when this becomes data driven from platforms outside of their organization, that it almost becomes, I think we mentioned the word on the show before, the Trojan horse. So this becomes the Amazon of trading, where the intelligence, the decisions, and the data is moved out of the company. It automates automatically, and suddenly you have a trading floor similar to the financial trading floor you mentioned before, and decisions are taken from a company with a few employees on a data-driven model.
It could be. Someone still has to maintain all the data, though. That doesn't necessarily do itself, but I think the role of the trader is bound change. And I think the role of a lot of these people working here and the skill set is about to change as well. And I think, what I think is that a lot these people won't disappear, but hopefully what they will do is use their time not on manual activities, executing a trade, updating a schedule, checking something. More of their time should be done on actually value creating activities. So I would assume that these people are then transferred to the development of strategies. Because when you have all the data in place, then someone needs to develop the underlying strategies. And hopefully, today, I'm guessing they use 80% of their time on data management and 20% on strategies, while they should be using 20% of their time on data management and 80% on developing the best strategies.
So you
But on
seem
the
to
other
keep going.
hand, sorry, but on the other hand, your example of the financial trading, they actually did disappear.
Yes,
The big trading floor. So it could be.
it could be that that happens here as well. But again, there is a fundamental difference here as well, is that, again, the connection to the physical world. Because they're a power, in the end, these are power plants that needs to be controlled. And yes, a lot of these can be automated, but whether all of it will be automated, that's the question. But definitely more than today.
So, so what I'm hearing is we go back to kind of a cultural shift or a skill set shift, right? So, if I look at the conversation we've had so far during this conference today, is we started saying, okay, well, there's two kind of camps where you started trading from, right? You came as you're a commodity trader, or you came more from an engineering camp. And what you said is the line kind of is blurred. They're moving closer together, I think, because you need to facilitate that. And part of your day job is facilitating getting assets, closer to the trading, but it's also the cultural shift in the people. Then we went on to talk a little bit about, the automation and managing data and all these different skills. And once again, it seemed like that there's an education in either it's the same people or different skill set needed to do this job. And the future is what I'm hearing evolve. So let's play this forward. So where do we go? So you talked about these new, the TSOs were doing some things to provide some new launches. Where is this all going? Where's the future? Let's I think the what we just talked about was maybe the 2 to 3 year timeline horizon, but let's start looking further out where all this goes. What's your crystal ball saying happens here?
Well, I don't have a crystal ball, but I think some things are quite clear. I think from the asset side, the asset mix will continue to change. We see that what's being built today, that is mainly intermittent renewables. And at some point, who knows when, we'll also kind of have batteries and hydrogen as well. And kind of battery wise, I think we're still quite early in Europe, but I did earlier this year, I did visit the Moss Landing in California, which is in Monterey Bay, which is the largest utility scale, or is going to be the largest scale utility battery in the world. As of now, I'm wondering, of course, if that's in the money. But if the technology curve continues, batteries could be an interesting part of the future. Same goes with, of course, with hydrogen. So that's kind of the asset side, what will happen there. When it comes to the market, I think it's quite clear that markets have, and they will also continue moving towards real time with small minimum volumes. And it will then be interesting to see who will then manage these smaller volumes. So as of today, if you look at the participants on the consumption side in the power markets, it's mainly large industry, so aluminum melters and so on. We do see some smaller industry coming in towards aggregators, but I'm wondering kind of who will take the position then when kind of that flexibility goes to an even lower level. Will it be aggregators that do it? Will it be me as an individual? Will it be the large entities taking it on behalf of others? I don't know, but all are possible.
And so there's an automation angle to this, right? Because as you increment that down, and I think Johan brought this up in one of his questions earlier, at a certain point, when you're doing large volumes and things, it makes sense for traders, and as it gets smaller and smaller, it gets it kind of we saw this change in retail. We've seen it elsewhere where the models change, or even from my experience when I watched even like the media industries have changed, with faster, more transactions and smaller margins on it. What about with renewables, how much of the market is controlled by, in the early days, it was really offset, whether there were government incentives, how does that change what's happening today? Is the incentive model really changing the market that we're seeing in the near term for renewables?
It's the incentive model that has of course created the growth in renewables that we have today. In the beginning, it was the feed-in tariffs, and in kind of now the financing model for all of these are of course they're standing on their own feet with PPAs. But what's going forward, what will be interesting, how that will grow, that depends, of course, it's a financial decision. What is the cheapest to build? What will be the cheapest to build, and what will be the cheapest flexibility to build?
And so, going back to your supply and demand, right? Right now, there's a race to just build renewables and as many suppliers and small suppliers in place. So that has got to weigh into this as well, from my take, long term, right? So there's the near term, we're kind of stuck with what we have, and then long term, we go there. I guess, is that part of your transition planning now? Are you planning for the long term, or is most what your companies are doing, you're working with, just trying to figure out the next 2 to 3 years right now?
Well, I think a lot of our customers, of course, are thinking they have their short-term jobs and have to focus on the short term, but I think a lot of them are also planning much longer ahead, and so are we. And we see as a software company that we need to be more scalable. We need to make sure that the model that has worked well for the large utilities, kind of the large system, has to be transferred down on a lower level as well. We have to create scalability so that kind of the market access of the assets of the large power producers also can be given on a much lower level.
Sorry, we've discussed on this show a few times regarding the ecosystem around energy. So as you're saying, the scalability is, of course, extremely important. From a software point of view, that is pretty much standard, I would say. That you build software for this. You have the renewable energy that is growing. You have some of the flexibility, as we discussed. But isn't there one fundamental here that might not follow, and that is the distribution of this and the grids? Are they ready for this change? Even if you scale it and the number of prosumers, the small energy parts that you can trade on the platform, but can it actually be distributed?
The distribution grid is not ready for this. And kind of the traditional approach to that has been, of course, build more grid. But that's going to be too costly to do something about that. So we need to do something about with local flexibility. And what we see the emergence of several places is, of course, it could be the grid company solving this themselves by installing the batteries locally and so on. But it could also be that the market model that we have on the large scale level is brought down on the DSO level as well, meaning that we will see the emergence of local markets, which kind of helps the distribution grid. And we see the first kind of pilots or examples of that's these days. But I believe in market mechanisms of solving these challenges. And I think also on the distribution grid that the kind of local markets could be a really good option to the big investment costs that would otherwise come in the distribution grid.
Mm.
And so you see prototype of that right now in existence?
Yes.
And then what's keeping that from happening today? Is it just they're not ready yet and they just want to get through it, or why is this not widely adapted yet?
Well, it's we're early. I think first the DSOs needs to realize that this is an option, and they are, and then it has to be the right incentives for all parties, of course, to do it, both on the consumption side and on the DSO side as well. The DSO they need to really get better at forecasting where in the grid this will happen, and then be able to acquire that flexibility in a manner from a market. But I think this has to evolve. And I guess the next years we've seen pilots, we see some of these markets becoming operational. And I think I'm predicting at least 5 or 10 years from now, these will be an important part of solving the local grid challenges as well. So not only large scale, but also the smaller scale. And the operation model is similar. We talked about the TSO markets earlier. The TSOs need to maintain the kind of the global frequency and voltage level, Well, this is the same on a lower level.
So what I'm hearing repeatedly is scale is going to be important, because if you have all these smaller increments, there's going to just be more. The time lanes are compressing, so it seems like things go quicker. So automation is a key element of this. And new skills are what the traders need to do, because their job is evolving to differences. And those are the things that you see where the market is today and where it's headed. That's I think the recap of what I hear. Johan, what do you think about what we've talked about? Maybe you can help us pull this all together for our audience of where we've gone on this journey in this call today.
I think we've been a little bit all over the place, but I also liked it because we talked about the future, and the future is, as Ola said, there is no crystal ball and we don't have it. So even if we ping pong back a little bit, I thought it was interesting, and I think it's pretty clear that you take the kind of the old world of the asset trading and the new trading, you bring the software to it, and I think that's kind of where we build it on scale and start working more as the ecosystem rather than the silos. But I know we're running out of time, but I have maybe just a little bit of a last question, which
Sure.
you can answer pretty quickly, I guess. You mentioned in the report, which I really like, with the Nordic producers regarding the average time of executing a trade being 10 minutes. In the next 2-3 years, deploying softwares around it, what are we down to?
We're down to milliseconds, and that's technically possible today, and a lot of companies are getting there. So I think we are going towards in order to be profitable, you need to do more trades in a shorter time and have that whole value chain working. So I'm predicting that we have it down to seconds or milliseconds.
All right.
And that will enable. So we have the tools, but I think the power producers need to understand that it takes time to implement this. But we'll get down to thousands of trades per hour is my prediction.
Well, cool. So it sounds like in order to hit those times, you would have to be automated, because it's human would be the slowest element in that decision process from what you just described. So, well, cool. Any final thoughts as we wrap up this episode?
Well, I think my recommendation, of course, to anyone who owns asset is to take a good look at yourself and see how well are you prepared for this future. Because I think there's two things that are certain. I think one thing, the pace will continue picking up, and secondly, I think if you don't prepare, you lose out on profits. I think you'll have employees that are caught in manual tasks, and I'm sure you'll have the board of directors above you say, "Why didn't you do anything about this when you had the time?"
Fantastic. Well, thank you for taking us through this journey. Like Johan said, we went a little bit all over the place, but I think that coming out of this, I know a bit more than I did coming into it, which was the goal of today's episode, and hopefully our audience felt the same. So thanks for being on this podcast. And for our audience, you spent another hour listening to Insider's Guide to Energy. If you've enjoyed this content and you want to find out more, don't forget to subscribe to our LinkedIn channel or go to our YouTube channel to see us making this show in person. And if not, we will see you again next week. Thank you for your time. Bye-bye.